Hello, everyone. We are already 5 minutes late, so Arun, sorry, you'll have 5 minutes less in your presentation. No, of course not. The floor is yours.
Great. Thank you very much. I should apologize in advance that my voice is going, so hopefully I'll be loud enough. So this project is motivated by kind of the fundamental question for us as development economists, which is, why do we see persistent poverty? And we think often of persistent poverty, of households doing the same thing generation after generation. One of the reasons we think of that as being a puzzle is that when we look at evidence from, say, asset transfer programs as just one example, you see that the return on investment is very high across a range of developing countries and across a range of investments. So this graph shows, on the horizontal axis, a bunch of different countries, and on the vertical axis, it shows the rate of return on asset transfer programs. These were, in this case, all programs that handed out some kind of livestock. And what you see kind of consistently across the piece is that rates of return are high. And also, there is some drop-off where it's like 25% on the left in India and Bangladesh, and it's lower as you get further on. And if there's time in the questions, I'm happy to talk about, actually, my paper will rationalize even why we see this pattern, but it's not something I'm going to focus on today. So these bars are based on data from a couple of papers cited at the bottom, and in particular the red bar, Bangladesh, is the one you should bear in mind because the data for the rest of this paper is going to come from that source. So it's the QJE paper by Oriana Bandiera and co-authors. So what I'll do is I'll give you a mechanism that can kind of explain why we often don't see, given that we see these high rates of return out there, the question is, why don't we see people investing more in these assets? And one reason we think that should be possible is we know households can borrow informally with each other. So we know that if I have a bad shock, I go to Leandro, and Leandro lends me some money. And when he has a bad shock, I lend him some money back. So given that we know that kind of relationship can exist, that we see informal borrowing take place, the question is, why don't we see informal borrowing take place to engage in investment? So I'll talk to you about a mechanism that will explain this. I'll lay out a model that will kind of do it formally, but we obviously won't go through any details. I'll kind of tie it in briefly to the literature so you have a sense for where this fits in what we know already. Then I'll talk to you about the data. So this is the Bangladesh data we talked about a slide ago. And I'll give you the results and some policy implications from this. So coming back to this example with me and Leandro, borrowing for consumption smoothing is a self-enforcing relationship. So, I have a bad shock and I ask Leandro for some money. And he doesn't lend to me out of the goodness of his heart. He's a very nice person, but he lends to me because he knows at some point in the future he's going to want to borrow from me, and if he lends to me today, I'll lend to him tomorrow, and this will just continue. And the more variable our incomes are, the easier it is to have this kind of relationship. The more costly it is to me to have bad shocks, the more I want to stay in this relationship with Leandro, and so I'll make sure that I lend to him the period when he needs it. So why does that not work when we're thinking about the context where I want to borrow from him to engage in investment? Well, this may be obvious to everybody else, but it took me some thinking that, actually, it's no longer a repeated game, right? Like I borrow from Leandro, and that changes the value of our relationship in the future. If he lends to me today so I can invest, I might say buy a cow. A cow is going to raise the level of my income. Typically, you should think about it as reducing the variance of income. So as we all know, in a developing country context, actually even trying to go into something like wage labor is very risky. And so having a second source of income like a cow that you can milk is going to actually typically reduce the variance of your income. And the two of these things are going to go in the same direction to mean that I'm not going to need insurance from Leandro as much in the future. And so the fact that I'm going to not need him as much in the future is going to worsen the risk sharing that he gets from me. And because it will worsen that risk sharing, what will happen is that he won't want to lend to me up front because he knows that he'll be worse off in the future. So to kind of capture that mechanism in a formal model, you can start with something like Ligon, Thomas and Morrell's model of risk sharing with limited commitment. So it's just a standard model with 3 ingredients. We are risk averse. There is risk out there, it's partly idiosyncratic, and there's limited commitment in the sense that in any given period, any of us could choose to walk away from that relationship. And so the relationship will only be enforced by the fact that it's worthwhile, the continuation value, the future of staying in this relationship makes it worthwhile for us to continue interacting. So start with that standard model and add in one twist, one extra ingredient, which is the possibility not only to have insurance, but also to engage in investment that's lumpy. So thinking about buying something like a cow. So it comes in units, you can't just buy a quarter of a cow at a time, you're really thinking about buying a full cow or nothing, and that we kind of want the size of this cow to be large enough that it's not epsilon. And so just having those things together, there's some technical work that you need to do to show these results, but just having those things together will give you this trade-off between investment and insurance incentives. And in particular, the key result that comes out of it is something that I describe as a network-level poverty trap. So it will be a poverty trap in the classic sense is just going to be a situation in which the long-run distribution of income depends on where we're starting off from, and it will be at the network level in the sense that there might be some group of us that we'll call the network who are engaged in some informal risk sharing, and either all of us collectively will be below some threshold in terms of our aggregate income. That means we're never going to be able to engage in investment, or we'll be above that threshold, in which case we'll be able to engage in investment. So I'll come back to this in another slide's time. But first, just you might be thinking, oh, I've seen all this before, like poverty traps, come on. This was like the first thing I learned in development economics. So it's clearly a very old idea that poverty traps might be out there. And typically when we think about poverty traps, we've thought about them as a household level phenomenon. So you might think about a situation where, for example, I'm very poor. That means I can't afford to eat very well. That means I don't have a lot of energy. I can't supply a lot of labor. And that means I have a low income. And because I have a low income, I continue not to eat very well. When Francesco starts slightly better off than me, he can already eat very well. That means he has the energy to be able to supply lots of labor, and therefore he continues to get a good income, so he always stays fine. And so it's just, if someone could give me that initial, good meal or whatever, I'd have my nutrition level raised to the point at which I could work harder and continue to self-sustainingly have a higher income. So that's the kind of our classic model of a household poverty trap. And the problem, and it goes through other mechanisms than nutrition, but the problem has typically been that although we've seen it there in the theory, empirically it's been very hard to find evidence of any of the individual mechanisms in place. So that's led some people to conclude that maybe poverty traps aren't really the right way to think about the world, maybe they're not out there. A different approach which I would think of is maybe we just haven't nailed the right mechanism. Like the stylized fact that made us think about it is still there, we're just still searching for the mechanism. So here I'm proposing a new mechanism that you should think about, and it's that maybe we were looking in the wrong place. When we were focusing on household level poverty traps, we were just looking in the wrong place, and actually the poverty trap is at the level of the network, and that's where we should have looked. And so this might come back to something you have heard of before, like the big push type of poverty trap, and that is a group level, in a sense, poverty trap. But there, the poverty trap is motivated by pure coordination failure. It's that maybe some industries are all collectively valuable, but only if they can invest at the same time. And so there, all you need is sunspots. You just need something that can achieve your coordination, and you're done. Here, the failure is not just a coordination. It's really that we don't have the ability. There's no signal that someone could send us that would make us go and invest. And so informally, because I'm not going to have the time to talk about the details, although I'm happy to offline, the kind of three results that will come out of this kind of model are, firstly, suppose you get rid of this limited commitment part of the model. Well, then you get a poverty trap in a kind of trivial sense. You get something that looks like a household trap. We know that in a full commitment world, a group of households interacting, you could just think of them as a representative agent. And then we know that a representative agent could be in a poverty trap of the same form as the household trap we just discussed. We could always have a trap which is, I have no money, therefore I don't want to invest. If I have epsilon income, of course I want to consume it, assuming that at zero consumption I have very poor utility. So I would choose not to invest. So at very low income, trivially, you should see no investment taking place. But what we see is that actually at much higher levels of income, where collectively we have the resources, we still see people not engaging in investment. And so that's kind of what we want to explain, and limited commitment can do that. For exactly the mechanism we were just discussing, because of the fact that there's commitment problems, that limits our ability to transfer resources. Even when collectively we have the resources, we can't just give it to one person and get them to invest, because they can't commit to repaying later. And then the third thing is that actually, if you could improve the quality of insurance in the network, you might make it easier to get outside of this trap. So if you guys were collectively very valuable to me, so I really didn't want to leave your insurance network, then you might be able to lend to me. And even though having a cow means I don't need you as much, the fact you're still providing me great insurance is a reason why I still want to stay in this relationship. So those are kind of the things we want to think about empirically. So to go ahead and do this, what I'll do is use data from a large-scale, long-term randomized controlled trial that was done in Bangladesh. So this was a partial population experiment in the sense that first villagers are assigned to treatment or control status, and then if you are in a treatment village and you meet eligibility criteria, you get given cows. If you're in a control village and you meet those criteria, you don't get cows today, you get cows in 4 years' time, which means for 4 years we can study you and compare you to people in the treatment villages. So these data are useful for this project because there's a large cross-section of villages, so 1,400 villages, I'll have data on the risk-sharing network for a subset of these villages, and so I do some work to impute the network in the other villages. And I'm, again, happy to talk offline about how I go about doing that. The third thing is there's going to be this large injection of lumpy capital. People are going around handing out cows, and so this is going to give us that 0.3 I was talking about, that maybe if you were to hand out cows, you might be able to improve insurance within the network, and that will have an impact. And finally, there's a variation in the value of this injection. And so you can see the obvious empirical strategy is to compare networks that get different numbers of cows in villages that were treated versus networks that would have been given those cows, but no one was given cows because it was a control village. So that's kind of straightforward. So just getting straight into the results, this is what you see. So on the horizontal axis here, what you have is the value of the capital injection, the value of the cows that were handed out. And on the vertical axis, you see beyond the cows that were handed out for free, how much additional investment takes place. And what you see is that up to some threshold, somewhere around, maybe I don't have a pointer, to around 4,000, you can see that everything looks fairly flat, and after that, it seems to be increasing. So it's kind of nice as a graphical picture, but we don't know, is this significant? Does this mean anything? Well, there are formal tests for significance, even when you don't know the location of a threshold. So again, I'm happy to talk afterwards about this, but I do one of these formal tests. Actually, I do 3 of these different formal tests, and in each case, you find that the threshold is at this location, around $3,500, or equivalent to about 7 households in the village being given cows. And so below that threshold, what you see is that handing out cows has no impact on additional investment. So you hand out cows, there's no additional cows that are being purchased. Above this threshold, you see that the income that comes from these cows is somehow being used to engage in further investment. If you go to control villages, you see absolutely nothing is going on. So the ideal variation for this experiment would have been that different villages were randomly selected to get different numbers of cows. Unfortunately, that's not what I have. What I have is that villages were randomly selected to either get cows or not get cows. But if you were selected to get cows, how many cows you get depends on some characteristics actually of households in the village. So this is not ideal for what I have, but no one had ever considered even thinking about randomizing in that dimension because there was no reason to think about it at the time. So when the randomization took place, nobody thought this is a thing we should do. It turns out this would have been an interesting thing to do because it seems like it really matters handing out lots of cows. And so, I'm on board with anyone saying, well, what I'd like to do is rerun this, randomizing that dimension as well. But at least for now, you should think that you otherwise need an explanation that says somehow the interaction of handing out cows and underlying heterogeneity in the village has this really nonlinear relationship to try and achieve this result. So just to get a bit deeper into what's going on, just to give you a bit of the microevidence that's available in the paper, what you see is that so there's 2 columns here. At the top, sorry, the pointer doesn't seem to work. So at the top, what you see is what happens for villages that are below that threshold that I showed you. The second line shows you what happens above that threshold. And what you see is that when you handed out cows, handing out cows creates an increase in income. That income is used to increase food in both areas. It's not significant above the threshold because there's less data there, but it looks like pretty much the same point estimate. But non-food expenditure only seems to rise below the threshold, whereas above the threshold there's really no increase in non-food expenditure. Food is more spent on food, but actually then the rest of the money is used both for saving and a lot of it is used for loaning money to other households within the village. And so a lot of that additional investment you were seeing wasn't being done by households who got given cows themselves, by other households in the village. And so, you gave a few people in the village cows, and what they're doing is lending to one other person so that other person can engage in this additional investment. So just to wrap up, suppose you don't care about all the details of poverty traps and models and whatever else, like why does this matter if you're a policymaker? Well, it matters because there's growing evidence already that these kind of projects have big impacts. So there's a few papers I cite here, and this kind of program has been so successful that actually more than 40 countries around the world have something like this now. And so one goal of this paper is really to show you why there seem to be these unexploited high returns still sitting on the table, still out there for us just to go and hand out cows and have this effect. But the other thing is when you're thinking about the design of these kind of programs, what you see is that actually what you want to do is to target things at the network level. So the reduced form estimates that come from this paper suggest that a budget-neutral restructuring of the program could have increased investment. If you'd just got more of the villagers to just above that threshold, you could have increased the total investment by 44%. And so I think that's a kind of important thing to think about, even if you're not interested in all the details of where the poverty traps come from. So that's everything for today, and I'll hand over to the discussion. Thank you.
Thank you very much, Arun. You already know what I think about the paper, but I'll share with the rest of the audience. I think this is an amazing paper. One of the reasons is also that you take an RCT that was designed for completely different purposes, and you show something that is very different and very insightful and can actually help improve the strategies that are happening with BRAC in several countries. And you show, and it was mind-blowing for me because you show the existence of network-level poverty traps that are not a matter of coordination failure and are not a matter of big push. So it's a completely different idea. One question that I have is, these interventions were designed to reduce poverty. As a matter of fact, if you had access to microfinance, in a country like Bangladesh, where microfinance is prevalent and the vast majority of people do have access to microfinance, you are excluded from the program. So this was a program directed at poverty reduction. And there's perhaps a slight missing link in the idea. Yes, we see that after a certain threshold, investments increase. I'm wondering whether with the data that you have available, that I know is very rich, you can go back and say something about whether there is indeed a poverty effect beyond a certain threshold. And then I know that many of the households that you have were households of widowed household heads. I checked, and the words female and woman in your paper are almost absent, except for when you explain how the selection process worked. I was wondering whether you can exploit some of the heterogeneity, a little bit like you're matching control and treatment villages based on similar assumed network size to look at whether there are any gender effects, especially because we know that male and female female networks work in some countries in very different ways and different pathways. Thank you.
Shall I respond? Or do you want to take more questions?
You say.
Okay, so just on those couple of points. So the poverty reduction was really the initial goal of this kind of program, and that's really is quite an important part of what's going on. And so actually the original paper that I cite, where this data comes from, show the kind of poverty reduction effect. So the kind of goal of my paper is really to say, look, we know that if you give people income or a source of income, that will reduce their poverty in the sense you can get them above some threshold. The question is whether what you're doing is just to shift up the level of their income one time, or whether you can have their income on a growing path. So kind of what I'm showing here is that actually if you can get above some threshold, you can actually not just shift them out of some nominal threshold level of poverty by getting just at some higher income. You can actually get their incomes to be growing over time. So that's really what we see going on. On the female question, that is an important part of this program is that it's targeted at women, and female empowerment was an explicit goal of the program. Because always the counts are given to women, I don't have variation in terms of looking at men who got the program to see what happened. What one could do is to still...
So they're not given to the household, the cows are really, they're strictly given to the women.
They're strictly given to the women. I mean, a thing one could look at is to see whether women who are in households that have a male
connection to a male network.
Yeah, exactly. Are different from widows. I haven't tried to do that, but that's a worthwhile thing to think about. So thank you for that.
Yes, Andrew.
So I don't remember this part of the paper. So in terms of welfare, so if you give the cow, you're better off. But one of the implications is that if you give not enough cows, you break a risk-sharing network. Do you have any evidence that some of these guys who didn't get the cow got worse off?
So it is true that if you hand out, so what you should see, so it's something unfortunately, it's an implication of the model, but it's not something I can directly test in these data because I don't have a long enough time series to do what you would normally do, to study the risk-sharing network and how it changes. But an implication of the model is it would change the risk-sharing arrangement that's underlying in the network. And so there would be households in the networks that didn't get given cows that would get less good risk-sharing than they would have got beforehand. So that is an implication and is what I would assume would be going on, but not something I can test directly because I don't have the time series for that.
Questions? I think you need a mic.
No, on what you said just a few minutes ago, how do you characterize a growing path? I mean, what does it sort of look like? How can you measure? Sorry, so basically you mentioned that you wanted to see the difference between just increasing their income and setting them in a growing path. So what characterizes that? Yeah.
So what I'm looking at here as my kind of proxy for income growth is the ability to invest, because we know that we can see both, we know from the technology in general and also from what we can see in the data that buying cows is increasing the level of income. And so if we see additional investment taking place, and that's increasing income even further in the future. So you handed out cows, that increased people's income. They're using that income to buy more cows, which is increasing their income further. And that's what I think of as being on a path for growing. But the data only goes 7 years after, so I don't know whether even beyond the 7 years there's even further income growth. That would be, I mean, it would be interesting to go back and get an even longer follow-up. But up to 7 years later, you see that people are still investing and getting yet higher levels of income, which is what I would think of as income growth.
Maybe I have one more question. Going back to Leandro's point that, that the households that did not receive the lumpy transfer may face lower risk-sharing networks, or at least quantities. Maybe you can use the share of network. You show very well in the paper that the share of the network that receives the transfer does not matter. But maybe you can use that at equal absolute values of transfer, you have a variation in the share of the network that receives this. And you could use to test whether there is any estimated reduction in transfers for people that didn't receive. I'm wondering whether you can play around with it. Maybe we can discuss it later.
Yeah, maybe we should discuss it. That sounds interesting. So.
Okay. Thank you very much.
Thanks very much.
And
thank you all. So I'm going to present this work on risk sharing and demand for insurance, an experimental study conducted in rural eastern Uganda. Okay, so the motivation for this is, well, basically rural inhabitants of developing countries are especially exposed to risk. Okay? There is a much higher incidence of diseases and environmental hazards there, and also business risk is a major factor. So the majority of businesses, the majority of households actually run at least one business, typically a farm, okay? And these enterprises are typically undercapitalized, under-equipped, and very vulnerable to shocks. So a lot of this risk is uninsured, and this leaves poor households vulnerable to negative shocks, okay? They need to resort to asset and consumption smoothing, and also costly risk management strategies like risk avoiding, foregoing profitable activities in exchange of safer activities. As a result, I think poverty traps is, so welfare costs can be substantial and poverty perpetuating. So our area of study is a meaningful example of this. It comprises 2 districts in eastern Uganda with around 400,000 inhabitants, fairly homogeneous, so people are scarcely educated, they live in very kind of big households, and the majority of them are farmers, okay? 82% consider farming as their primary activity, and typically they do so in very small plots of less than 2 acres. In this area, weather risk is the most important source of risk, with 53% and 76% of communities affected by a drought or a flood in the last 12 years, respectively, okay? And then milder spells of bad weather are even more common, okay? And these have meaningful impacts. Also important for our story, informal risk sharing plays an important role in the area with many kinds of existing groups. However, these arrangements are better suited to deal with idiosyncratic risks affecting individuals in the network, but not the network as a whole, covariate risk, okay? So in this context, insurance would seem to be fairly useful, okay? But as most of us know, insurance is affected by informational problems like adverse selection and moral hazard, and especially enforcement problems, the high verification costs that preclude the existence of a market. So in this kind of context, a new form of insurance emerged in the last few years, index insurance, which is a financial product linked to an index, highly correlated with local yields, okay? And this index is typically related to weather events, and payouts are triggered with pre-specified patterns on the index, okay? So it was hailed as a very promising instrument to deliver insurance because it eliminates moral hazard and adverse selection by design, given that the policyholders don't have any influence over it in principle, and it also crucially reduces verification cost. However, it has a very important drawback, which is basis risk, okay? The imperfect correlation between losses and the payouts received from the insurance. demand so far has been fairly low, especially about the poor. A variety of reasons have been argued, like rate constraints, poor decision-making on the part of the beneficiary, interaction between formal and informal insurance, and deficit designs of the product. Our next speaker actually looked at this from a theoretical standpoint for the first time, trying to explain how a rational decision maker would act when presented with the possibility of buying insurance. In his model, he sees that the demand is decreasing in basis risk, okay, and increasing with risk aversion, but up to a point, even in the case that the insurance is actually fair. So basically, a rational decision maker may rightly choose not to purchase insurance, okay? The important work by Derkon and Mubarak proved this empirically, okay? They incorporate also informal risk-sharing, which they deem as a complement. So when individuals are part of a mutual support network, okay, this network can absorb basis risk and complement index insurance coverage, okay? So, however, this relies on the existence of an effective mechanism for sharing basis risk. And in many circumstances, it might not be there because due to weak enforcement mechanisms, okay, so which is a common characterization of risk sharing in the literature. And in fact, some argue that the sudden availability of formal insurance may actually crowd out existing arrangements. Okay, so our question is precisely trying to contribute to this debate. What is the effect of informal risk sharing on demand for formal insurance? Okay, we also look at how formal insurance actually affects risk sharing. Okay, so we'll present results for both. So we conduct a frame field experiment in which we contribute by varying exogenously both risk sharing to study its effect on insurance demand and also insurance characteristics to test whether this effect varies depending on the type of insurance, okay? And we also do this to investigate the impact of insurance status on the level of risk sharing. Yeah, so basically we derive our predictions from a model by Mubarak and Rosenwaite, in which they showed that the risk sharing can drive demand for index insurance against comparison up, okay, because it mitigates the welfare effects of the worst state when you basically experience a shock but don't get a payout, okay? But it can also depress it because receiving a transfer when a common shock is already indemnified, okay, can reduces the utility of insurance. However, risk sharing does not affect demand for indemnity insurance, okay? Yeah, and without basis risk, it's always advantageous to mitigate the effects of a common shock. In regard to risk sharing, what we expect to see is that when the partner is not insured, it draws more informal help, and when the partner is indexed rather than indemnity insured, it also draws better, more help. So the idea here is that when the partner is more likely to receive support, okay, when risk is exogenous rather than endogenous, dependent on the decision maker, okay. All right, so let me explain a little bit the design. So basically in the experiment, participants were allocated an endowment, which is equivalent to 3 to 4 days of wages, and they were anonymously paired with another individual. Person one in this pair faced a loss of up to 63% of the endowment, okay, and was given the chance to insure against these losses. Person two, on the other hand, could only use endowment to assist the partner, okay. So person one faced the probability structure that you see here, okay, so comprised by 2 shocks, a common, a weather shock, so the weather can be good or bad, and an idiosyncratic one, whether the losses actually materialize or not, okay, both of which were randomly determined. So the common shock basically made more likely to experience the idiosyncratic one. So it was 3 out of 4 chances when the weather was good, and 1 out of 4 chances when the weather was good, and 3 out of 4 when with bad weather. So participants were subjected to treatments that combine these 2 dimensions of the type of insurance, so that it could be index, the payout was disbursed when the weather was bad, indemnity, the payout was disbursed when the person one experienced losses, or no insurance. And then
The second dimension was the availability of risk sharing, whether it was possible or not. So this gave way to that matrix of treatments, okay? So for instance, treatment 1 was characterized by the fact that the index insurance was on offer and risk sharing was possible, okay? Treatment 2 was the same, but in this case, there was no chance for risk sharing, so person 2 couldn't help person 1. Treatment 3 and 4 were the same, but indemnity insurance was the cover on offer, and finally in treatment 5, there was no insurance, and person 1 relied entirely on the partner. Okay, so participants took part in either in game 1, which comprised all the index insurance treatments, okay, or game 2, that featured the indemnity insurance 1. So in total, we had 400 participants divided equally between the 2 games. All participants took part in treatment 5, okay, the no insurance treatment, and each partner fulfilled a different role, but each role was taken in sequence. So at first, everyone took the insurance decision, was person 1, and then they became person 2, the aiding partner. We employ a strategy method to elicit all the risk-sharing decisions. So basically, we asked person 2 how much they wanted to share for every possible decision of person 1, okay? Then all participants here were randomly selected, so were farmers randomly selected from a stratified sample. Okay, so these are the choices that they actually could make, okay? Person 1 could choose the level of coverage all the way from 0 to 4 units by ticking a box in this, like in a car like this, which feature all the relevant information, like the price and e-earnings. And person 2 have to decide how much they wanted to transfer to person 1, if anything, okay? For the sake of comparability, both products, index insurance and indemnity insurance, were the same in all respects, save for how they were disbursed, okay? So, yeah. So let me start with the results. So what we see is, what we see is basically summarized here, okay? So we see a significant drop in demand for index insurance when risk sharing is available here, okay, which goes from a median of 2 to just 1, okay. However, we don't see anything like it in the case of indemnity insurance, when indemnity insurance is the cover and offer. So it's regardless of whether risk sharing is available or not. When we look at the statistical test, we see that the size of the effect is fairly big, okay, which almost half a unit less when risk sharing is available, okay, and almost negligible effect, okay. That's the demand difference between the indemnity insurance treatments, okay, with risk sharing and without. We deploy an order probate model to look into this, okay, which has so treatment as the explanatory variable, and then several controls like gender, age, education, wealth, okay, and village dummies, and basically the main conclusion is that the comparative analysis holds, okay. So the anticipated risk sharing throws out demand for index insurance, but it doesn't affect insurance take-up. And that's the case when we use the pooled sample or when we use the individual subsample. So here we always have treatment 1 as a reference, which is index insurance offer with risk sharing, and we can see here a very positive difference, okay, with the demand when risk sharing is not available, okay, and again no difference in the case of indemnity insurance. Okay, when we turn to the risk sharing data, what we see is first there is no effect, okay, of being insured when it comes to loss sharing, okay. But you can see here, this is the risk sharing when the partner is index insured, okay, and this is the case when they don't have any insurance, and in here is when the partner is indemnity insured, okay. As you can see, the 3 bars are more or less the same, and there are no significant difference on the average. However, when we just used as a sample of people who are insured, okay, basically transfers are much higher towards those that are indexed rather than indemnity insured. And this grows with the level of insurance. Yeah, so, and when we look at the regression results, we can see that the size of the effect is very substantial, okay? So this is almost 15% of the losses that they could make. So that basically the person who is index insured gets as opposed to those who are indemnity insured, okay? So yeah, so being index insured draws a significantly higher level of support than those that are indemnity insured. So yeah, so basically to conclude, we find that when varied exogenously, okay, informal risk sharing deters demand for index insurance, but it doesn't affect indemnity insurance take-up. And this result is at odds with the prevailing narrative about complementarity between the two forms of assistance. Second thing is that being index insurers, as I was saying, crowds in informal support, okay, which partially explains the earlier result. And how long do I have left? Really? Because 2 more minutes. Okay, so maybe I can refer quickly to what we think it's going on, okay? So basically, we think that this is due to this anticipation risk sharing in part. So with index insurance, there is an expectation that a sizable loss sharing will take place, okay, due to basis risk. And anticipated this support, so people, basically individuals facing losses reduce their demand for index insurance, okay? However, such support is not anticipated in the case of indemnity insurance, okay? And the demand remains constant. There is, we believe that this very negative effect of risk sharing on index insurance demand goes a little bit beyond what the model actually indicates, okay? And we believe this is due to indebtedness aversion. So basically, people are averse to become indebted to others, okay? And this is a behavior that we have already observed in previous experiments. So basically, the idea here is because of basis risk, okay, the decision maker needs to contend with the outcome, the possible outcome that of making this very severe loss making the loss, and then also have to pay the insurance cost, okay, and then relying entirely on the partner, okay. So if for those who want to avoid kind of burdening the partner with such a big level of help, okay, so they may actually reduce the demand, so in case, to avoid this possibility. Yeah, so I think that's it. Yeah. Thank you.
Well, thank you very much, Borja. So as you already saw, this is a kind of an important paper that really tackles an outstanding question for us, which is, we know that informal insurance is out there and is an important part of how households mitigate consumption risk. And the question is, how, what's the best, to some extent we want to know what's the best policy mechanism to tackle that. Should we somehow solve some of the outstanding income risk that's there by, say, introducing something like index insurance, and how would that interact with the existing insurance that's out there? So I think it's a really important question that this paper is tackling. So one of the downsides always of discussing papers when you only have 15 minutes to present is that the paper has a model in there as well, and many of my comments are about that, which you guys haven't really seen. So I apologize that some of these comments are going to be maybe lost on the audience, so I'll keep them brief and we can talk about more of them later perhaps. Yeah. So maybe the ones that are kind of most closely relevant to the things that people have seen today. So one thing is that, which you actually have extended since I saw the paper, this kind of discussion about indebtedness insurance, aversion, because the model you have, as you say in the paper, doesn't entirely rationalize what you see empirically. Yeah. And I think part of that is you could partly rationalize it by things that we know that are out there, like the fact that the fact that one is a crowding out type example is in there in something like Atanasio and Rios rule. So there's possibility that we'd have crowding out. Seems perfectly reasonable in a world with limited commitment. And so because you write down a model in the paper that's a full commitment model, with full cooperation between households, that jointly making a maximizing decision, you end up with this. But I think if you were to relax those assumptions, I don't think these results would necessarily be surprising. I think you would be able to rationalize what you see empirically with a theoretical model that's out there already. So I think that you don't necessarily need to go down a behavioral route, although it would be reasonable also to think about that. The other thing that I kind of thought was interesting is that the way that the experiment is set up is another thing that you could just explore almost separately to this is that what you have is something like a dictator game, essentially, for player 2. Player 2 is playing a dictator game where he or she chooses how much to transfer. The other side has no choice over it, but the dictator is making a choice of how much to transfer, knowing something about what the income shocks might be for player 1. And so that in itself is an interesting exploration, because we typically think of a dictator game as just, I got $10, I get to choose how much I'm going to give to Borja, independently of anything else, and we just see, what's my altruism out there. But now this is a world in which suddenly I'm being told things about Borja as a person, and being told, oh, this is what his income is, oh, this is what his income is. This is his income, and this is the choice he made about insurance. And we get to sketch out, well, what decisions would I make as a dictator, given that I suddenly learned some things. And I thought that'd just be an interesting thing to explore. This is, a tangent, so maybe it's a separate paper, but it feels interesting to understand how people are making these decisions when they get additional information about the other side and what the influence is just directly there. And then I have some more kind of detailed questions about the model, but I think those ones are not really worth discussing, given that you didn't present the model. And I'll talk to you about them afterwards.
Okay, thank you very much. Maybe, so, I mean, those were mostly suggestions and comments, so which are appreciated, so in regard of how do you think, I mean, what would you like to see in terms of experiment? Because basically in the experiments, indeed, so persons 2 were told certain information. I mean, that wasn't necessarily final, so it wasn't determined yet, but still, their decision would apply if that was the actual case. So what do you think is, I mean, is it something missing there that they would like to explore?
So that wasn't a comment that said, oh, I think you're missing something in the experiment. That was a comment to say, I think that you could interpret this experiment differently as a way of understanding something. So we already know that when we do experiments, either lab in the field or just lab in the university, we run dictator games all the time and we use them as a way of understanding altruism.
Okay.
But this speaks to that question, but in a way where it's not just straight up altruism, where I know nothing about, if I'm deciding what to give to Francesco, this is now not a world where I just have him as a generic person. I suddenly start to know things about what his income is and what choices he made to insure himself or not to insure himself. And I'm now making a decision based on that. And that I feel like is an interesting other dimension to explore. I think orthogonal to this paper, and I don't think it would fit directly in this. But I think it's another interesting thing you can explore with the same data that you've already done this experiment, where we can learn more about how dictator games show up when we start thinking about the dictator knowing something about the person they're making transfers to. I think that would be a nice thing to explore.
I get it now, thanks. Any other... Thanks.
Hi, thank you everybody. So, this is a theory paper without any empirics, which I apologise at the moment. So this is on a slightly different topic. This is on insurance and insurance-like mechanisms, but for governments as opposed to for individuals. So really thinking about the development impact of them. So I work for the UK government, for DFID, and for this new centre that DFID has set up. So I'm definitely approaching this presentation to try to proselytise about, there are a set of research questions that I think DFID is interested in understanding better, that there's very little evidence on. And I think this paper is on the broad topic, but I'll come at the end, a sort of call to action on research. So loosely speaking, when it comes to development finance, there's quite a lot known about the impact of providing grants to individuals and governments. There's quite a lot known about providing loans to individuals and governments. I'm not saying we know everything, I'm just saying there is quite a rich literature on both of these. Loans to governments, for example, the World Bank, the development banks, they provide lots of loans to governments for development purposes, and there's a lot of evidence over a long time period about whether these things work and how they work. Insurance is a little bit newer, so maybe on the micro insurance side, so insurance for individuals, for a development purpose, there's a good 15 years when development economists really started attacking this. There's probably some stuff before then as well, but there is a moderate evidence base on insurance for individuals, and we've just heard a paper, and we'll hear a paper just after mine on insurance for individuals. I would say this whole question of risk management for governments and this question of insurance for governments, there's almost nothing. There's some research on it, but pretty little research on this. So this is what this paper is on. It's on this paper of insurance for governments. Now, is there a weak evidence base? Because basically this isn't a very important question. Or is this a topic where it would be good to have more evidence? So I would argue there is a need for more evidence, and the UK government agrees. So the UK government, DFID, has 4 overriding policy documents. One of those policy documents is on its humanitarian reform policy, and within those, one of the 5 key things it wants to do is move the global system for humanitarian response from responding to shocks to managing risks better. And a big part of that is in terms of the financing. So thinking about what is wrong with the way that the world currently finances shocks, and this is donors like DFID, as well as governments in developing countries, and are there things that can be done better? In the same way as, 50, 60 years ago, IDA was set up with the idea of providing cheap loans to governments to try to have development impact. Is there a rationale for thinking about insurance for governments as a development purpose to meet development objectives, and if so, how? But the literature is pretty scarce on that. Practice in this area is moving on quite quickly. So this is the Centre for Study of African Economies conference, so I would be remiss not to mention, so in the bottom row here, this African risk capacity. This is an insurance company that has been set up in Africa by the African Union. It's owned by African governments, and its remit is to sell insurance products to African governments, to its members, to its owners, essentially, against drought and things like drought. And it's pretty new. It's only been up for a few years. You've got one in the Caribbean that's been up and running for more than 10 years. It's paid out over $100 million in claim payments, over half of that last year with the hurricanes last year. You have a similar government-owned risk pool in the Pacific. The World Bank has set up a pandemic emergency facility, which is basically a sort of an insurance-type financing scheme for pandemic response. You have a big initiative led by Germany called Insure Resilience, which has an aspiration to try to increase the penetration of insurance, including insurance for governments, by 2020. The UK government has just set up this centre, which I work for, which is obviously wonderful. And the World Bank has a big programme that's been running for about 10 years, trying to help develop and set up these sorts of insurance-like mechanisms. So this is something where there's a lot happening, and there's very, very little research on it. So in that context, what does this paper do? So we all know that one thing that insurance can do is it can help to pool risk. It can reduce sort of consumption volatility or expenditure volatility for an individual or for an entity, but it can be expensive and complicated. So is it really worth the while for governments to buy insurance? It may reduce their risk, but then on the other hand, there are all sorts of, it might be costs, and it's really difficult. It might be difficult to buy something that's sensible. You have to look over the details, and that requires quite a lot of capacity within government to sort of make sure you're buying something sensible. So maybe if you're just thinking about risk pooling, if you think back to the 1970 Arrow-Lynn theorem, which sort of says that governments should basically be risk neutral, so they shouldn't buy insurance. This may not be a particularly good motivation for governments buying insurance from a development perspective. So what this paper does is it introduces a few other things that insurance could do. Well, a few other problems that governments face when they try to manage risk, and through that, a few other things that insurance could potentially do, or insurance-like mechanisms could potentially do. And I'm just going to talk about I'm just going to talk about 2 of them in my slides today. One is to do with increasing the response speed of relief. So you might end up in a situation where you have strategic delay. You have after a disaster, multiple people want to help, but there's a bit of strategic delay in who's going to respond, and you might end up with an equilibrium where people respond late, and insurance can help to break that. The other one I'm going to talk about is this idea of reducing aid misallocation, and what we're going to show is that in a world without commitment, you might end up with lower incentives to invest in allocating aid accurately, whereas in a world with commitment, if insurance helps you as a commitment device, you have stronger incentives to make sure the aid goes in the right place, to invest basically to target the aid better. So the basic model, so if you think, so again we're at CSE, so if you think about an African country or a developing country, so you could think about them as the recipient, and you think about two or more benefactors. This might be donors or individuals or people who might, in the event of a big disaster in that particular locality, might sort of come in with some support after the fact. So you've got sort of some benefactors and you've got a recipient. And the recipient, the government can invest in self-protection, and the benefactor can sort of come to the rescue after an event with some aid if they incur a loss. And we focus on situations where there is potentially a commitment problem. In other words, where it would be optimal for the country to invest in self-protection if they and the benefactors could contract over aid, the aid level and the investments in self-protection beforehand. So we're looking at sort of situations where there might be commitment problems and multiple payers. So the first set of results I'm going to talk about is to do with delayed disbursement. So suppose that the benefactor can, after a potential shock, they can give aid either immediately after the shock or sometime afterwards. And we assume that if they give it late, then that has lower impact, or it's higher cost per. So it costs more to have the same impact if you give the money later, which is what we find for lots of shocks. So quick money is often more useful than late money. And we show that if you've got enough of these benefactors, then you can end up with an equilibrium where everyone gives money late. So none of the benefactors come in immediately after the event, they all come in late. And what we show is that if instead the benefactors are able to coordinate on insurance as a commitment device, so they sort of jointly invest in this insurance, the insurance can be set up to lock in earlier, and by early we also mean sort of more cost-effective response. So there are various estimates for drought in Sub-Saharan Africa. There are various estimates for how much more effective fast response is than slow response. For sort of extreme famine-like circumstances and sort of the 84-5 famine in Ethiopia and similar in Zimbabwe, there's evidence to suggest that early response could be 3 times more effective than late response. For the sorts of droughts that you see more recurrently in Africa, the multiple might be much lower than that. But you're talking about potentially significant savings for acting earlier rather than later in some circumstances. And if that is the case, then this, maybe it's worth thinking about these sorts of instruments even if they have a cost. So this is a sort of an additional benefit, potential benefit of insurance or insurance-like contracting. The second point is to do with misallocation. So if your benefactors can't actually observe the true loss, but they observe a noisy signal of the loss. So, for example, if you have a drought in the country, it's not quite clear whether it is a sort of a moderate drought or an extreme drought. There's some sort of noise around that signal, and the benefactor who sort of can come in afterwards and provide aid doesn't quite know exactly what the real situation on the ground is. But the benefactor or benefactors can invest in a technology which gives you a more accurate estimate. So they have the choice. You can invest to give a more accurate estimate of how intense the loss was, or you can choose not to invest, in which case you have a noisy estimate of the loss. So you as a benefactor can choose to invest in a more accurate estimate or not. And essentially you are the incentives for investing in this are stronger either with commitment or, stronger if you can invest beforehand in a situation with commitment than if you wait until after the shock and then the benefactor has to make the decision, well, okay, we've had the shock, now do I invest in this or not? The incentives to invest are weaker than the incentives under commitment. So what this means is that in a world with limited commitment, commitment devices, if insurance is acting as a commitment device, this can increase the incentives for investment in accurate data on the size of the loss, and therefore sort of investments to reduce aid misallocation. Okay, so that's all I'm sort of presenting in terms of the paper. Just some sort of takeaways. So I do think there is a big gap in the literature on this topic. I think it is quite interesting. I think there's a lot more. If you think about mechanisms like African risk capacity or the like, which are sort of being set up all around the world now, and there's a lot of work being done on these. There isn't an awful lot known about them. We're starting to get a lot of sort of information from practitioners. There's recently been a very good independent review of African risk capacity, which is sort of rich for information, but there's very little independent academic research on it. So practice is moving quickly. There's a very sparse evidence base. It's quite important. DFID isn't alone. DFID and other donors, Germany in particular, really see some potential for this, but there's not an awful lot to base this on. So what the paper does is it sort of says that if you're thinking about insurance in the context of governments, then don't just think about this as a consumption smoothing device. There might be some other things that might be relevant and might actually, potentially be quite material to the decision about whether a government should buy insurance or not. And then finally, so this is definitely not a finished paper, so any comments would be very welcome. Yeah, thank you, that's it.
Thank you, Daniel. I must say that I quite enjoy reading the paper precisely because it's something that you don't come across very often. So I found that, actually maybe I should summarize briefly. So the paper addresses commitment and allocation problems in disaster risk finance, okay? So it does so by developing a model which considers each problem in turn and kind of identifies them quite precisely in the proposition. So, and then proposes some solutions that involve indeed risk transfer and to tackle them all within the light of the theoretical framework. So as I was saying, so I found the outlook very kind of refreshing and necessary indeed, because it seems to be something, quite a huge problem that you don't see much in the sort of academic literature, which is very focused at the micro level. I mean, at least also I'm biased as well for what I read, but that's certainly my impression. However, it kind of begs the question of how you can test this, or how can you kind of prove that this, what you are actually saying could work? I think that the paper sets very kind of ambitious goals because they are all very highly policy relevant, okay, and indeed we are dealing with issues which can hold up aid when it's most needed, okay? So, but I think it's bogged down by all the multiplicity of situations that is sort of presented there. So, so I think there is, this attempt to generalize, it makes unclear where the analysis actually applies. So actually your introduction was very useful because it sort of put the focus at the government level. So if that's the case, it needs to be made very clear in the paper, or clearly in the paper, or when it doesn't apply. So, in connection to that, it would be quite interesting to see examples that give some context in, about where the analysis applies, okay? That personally, I felt that made that a little bit difficult. There is something that you didn't talk about, this Samaritan's dilemma, that I had more issue with, so I will skip that part, unless, I don't know if it's still in the final version, or...
It's in the paper, yeah.
It's in the paper, yeah. Well, anyway, maybe I can talk to you later, because it's not something that was went through. Then there is this thing about how private finance and insurance, whether it's a bane or a boon, whether it's something good or... and I think that's really kind of crucial and probably the most interesting bit of the paper. So, you rightly point out that in some cases, it has some issues. The high cost, not many incentives for companies to actually improve in products. But at the same time, many of the solutions proposed rely on kind of private-public partnership or basically the introduction of private initiatives. So it wasn't very clear to me how your solutions actually overcome the problems that you highlight about private insurance in this context. Okay, and I was kind of going through the paper trying to see if there was more on that, but I couldn't find. Really, what I think would really enrich the discussion. And yeah, so those are my comments. I mean, I have more, but I'll give it to the rest. Well, to you.
So thank you very much. So yes, there being sort of lots of different models and too much going on, I accept. So I think one of the things we have to do is try to focus the paper a bit more. Make it clear that it's government insurance, yes. So in terms of how to test, so this is the million-dollar question. So there is now the first ever randomized controlled trial of one of these things in Mexico, which is really good. And that basically comes out with the result that if all that this scheme is doing is consumption smoothing, then well, basically consumption smoothing can't explain the results. So it sort of finds, I think the latest results are something like 4 percentage points increase in local GDP for the 2 years following a disaster through this scheme. And there's no way of rationalising that if all this is doing is consumption smoothing, because these shocks are not big relative to the government of Mexico's total budget. So I think we sort of have, there is some other work. I think the difficult thing was sort of, we wanted to sort of, it's a question of what comes first, theory or empirics. I think this is a very new area, so we've sort of come up with some theory and we haven't really applied it anywhere, but I think this is the next step. And I think, I would say, so I think this sort of, this idea that developing country governments find it difficult to commit to contingent liabilities, there is a commitment problem when it comes to risk. I think, speaking as a practitioner, I think this is really true and very salient. I think it's also true in lots of parts of the aid system, NGOs, humanitarian agencies, and so I think I see over the next 5 years there's a lot of potential for doing, a lot of really good research with NGOs, humanitarian agencies, governments to try to unpick some of these things that come out of this paper. But yeah, the paper doesn't have that it doesn't have those tests yet. Maybe the next version of the paper will. I'm looking at my co-author. So I think this is something we're definitely thinking about, and particularly in the context of the humanitarian system. How the solutions solve quality problems. So I guess, so I guess if you have donors paying premiums or partly paying premiums for insurance products, then I think you can probably expect pretty rigorous quality assurance processes. And in fact, the centre that I now work for, our day job is doing quality assurance stuff for these sorts of products and helping governments to make informed decisions about it. So I agree with you that the paper doesn't really address these sort of problems with quality, but I think it's easier to address problems of quality when you've got sort of one product for a country or one thing for a country, rather than if you've got a product that you're retailing across 100,000 households and you don't really know the risk profile of those households, and it's a complex product. So, but no, thank you for the comments.
Hi. So I'm currently working on model of insurance in Malawi, using Malawi microdata and like a big representative data. And I think we think it plays a big deal for a lot we can discuss. But so my knee-jerk reaction to your presentation was, why give it to government? Like, we have a whole decades of literature. We don't even work out if aid's helpful or not. And almost like I'm all lost heart just when you mention those words. But then you give the example of Mexico, which is a country that works. So then immediately, the next thing, if you have to give it to governments, I would rather use cell phones and come up with ways of identifying. It's like, if you remember the Rachel Glenister presentation about this big intervention in India, where what they did is just to cut the intermediaries and give it straight to the district that needed it. So I think that's where insurance for risk disaster should go, right? We should know where it happens, and there should be cell phones for the chiefs or something. I don't know, we should do something like this. But if we're going to go through governments, I think there's a whole discussion about the conditionality of aid. And a model of insurance should have moral hazard and should have this I mean, the type of policies, in a way we've been giving them aid. If you give a lot of aid, you should be preparing for that. There are policies in Malawi of, for example, asking people to come and invest in soy for export, and then when the soy is produced, they prohibit export of soy. So it's like, it's a kind of, is screaming for conditionality of aid. If there is a disaster, we're gonna give you aid anyway, because we won't be able to say no at the time. But if you want this to just be well done, here's the premium, we're gonna pay for it, and exchange. And I think so a model, maybe if you start putting those moral hazards there, you would start immediately asking for a conditionality. And because it's not aid, it's insurance, maybe we can get away with that politically. That's big, sorry. Thank you.
Excellent comment. So just responding to that. Okay, so there's so I guess we are in a world where we do have institutions that people invested in, the World Bank and multilateral, African Development Bank, Asian Development Bank, that are working with governments, specifically with loans and grants, to try to do this sort of thing. And I guess I would say that insurance is potentially another thing that can be within that suite of tools. And there are some things that the current list of instruments that development banks use, they're not very good at, so they're not really very good at risk, and insurance could actually be better at risk. I agree with you about money going through. So I guess I see this as sort of it's a complex agenda that touches on lots of things, including, it's a public policy agenda, though. It's not just a financial market agenda. So some ways in which these are used. So in Kenya, for example, there was an insurance product which was, the money sort of went straight to cash transfers to vulnerable households. So you're not really insuring government balance sheet. What you're doing is you're using insurance as a way to commit to a particular function of government, or a service provision, or a provision of social protection or something. So it really is, and this is this is the book that Dole Disasters, which I wrote with Stefan Derkel, which was related to this paper when we were sort of developing it, which sort of argues that you really want to be developing systems of protection at the sort of micro scale. You're not just sort of pumping money into governments as budget support, and then sort of hoping that that leads into good risk management. So really sort of bottom up micro level schemes. So the African Risk Capacity, which I also mentioned, they are also offering insurance to NGOs and humanitarian agencies. So I think next year is going to be the first time they actually sell an insurance policy where they sell an insurance product to governments in Africa, and at the same time a matching insurance policy to NGOs. And the idea is that the NGOs and governments work together, they have a common product, and also they work together on how the money's going to be spent. So it's a way of sort of encouraging a sort of partnership in terms of how money is dispersed and where it goes. And but there's a lot of experimentation with these sorts of business models, but we're really very early days in terms of how the money should flow. But yes, how the money flows and what it goes to is almost more important than sort of where it comes from.
Thanks for your presentation. So I was wondering what your model actually says about idiosyncratic risks at the household or individual level. So for example, regardless of the delivery mechanism, I was wondering if your model says anything about how households would react, whether it would crowd in further insurance at the household level, or in fact create incentives to not insure their risk, their idiosyncratic risks specifically. Okay, so
I guess the paper doesn't really say very much about that. I mean, you could apply the theory of the paper to a sort of household, and your benefactor could be, a wealthy person in the village, or it could be a relative who goes off and lives in a town or something. But the model wasn't really designed for that, I guess. So I guess this is much more about. It's sort of inspired by the idea of, you have a government where in the event of a disaster there are certain things they need to do, and there's a question of who pays, and instead of waiting until after the disaster to work out who's going to pay and how, is there a way of contracting beforehand on that? So there probably are implications, but it's not in the paper. So maybe this is what something fits into the category of things not yet looked at, which should be.
As a closing question, since I didn't see any other questions in the audience, have you thought about the political economy implications of this? I mean, if you're talking about democratic governments that are transient by nature, whether this will actually affect in any way sort of the assumptions you have in the model?
So we have thought a lot about. We have thought about it. It's not very much in the paper. So I guess. In the paper, we sort of assume that there is a set of good things that could be done after a disaster, but those things might happen late, or they might happen in an uncoordinated way. And the way that the financing works, particularly between multiple partners, so the government and these benefactors, might lead to bad outcomes. Even if everyone is trying to do the right thing, the way the strategic interaction works out. Because it's limited commitment, you end up with equilibriums that you don't, inefficient equilibriums. But I think the so there is related research on the politics of disasters and the incentives that politicians are faced with when it comes to disasters, and these are extremely relevant for this topic and agenda, because the incentives for most politicians is pretty much always to wait until a shock happens and then come in and announce that you're doing something strong about it. But the point is that all the people underneath you, the implementers, don't know what they're supposed to be doing until the point that you make the announcement, so they can't prepare for it, and it's not their day job, and so risk just isn't managed very well. It's very much a sort of ad hoc response model. So it's sort of one of these issues where there's the right thing and then there's the politically easy thing, and how do you set up the institutions in such a way that you end up with the right thing sort of happening. So I think it was sort of but there's not. So all the agents in our model optimize are sort of rational in a sense. So we made a conscious decision that we didn't want this to be about people having screwy preferences. We wanted to tell a story whereby everyone was trying to do the right thing, as it were. It's just the strategic, the lack of commitment was basically causing inefficiency.
Okay, thank you very much.
Thank you.
Thank you. I'll be presenting an RCT that we conducted in Ethiopia some time ago, and we are already now in a second and third phase of a study around on this topic, but I'm going to present today just the results from the first wave. And the motivation behind this study is that there's an increasing body of literature that says that one of the most important and most binding constraints for investments by smallholder farmers in Africa and in other parts of the world are uninsured risks. However, there's also another body of literature that says that no matter what you do, uptake rates of weather insurance are low. So putting these two things together, our idea was to sort of try to understand whether, given the reasons cited in literature why uptake of index insurance is so low, can we try to relax some of these things in one way or another? And in particular, we focus on the extent to which people trust the insurance. And of course, trust is a very complicated concept. You can increase your trust by understanding a product better. Here, we're really trying just to sort of have the people approach, the insurance approach people through a more trusted source, and whether we can sort of reduce the constraint with respect to liquidity. And what do we do exactly? On the one side, to sort of weaken the trust constraint, we market the insurance through local informal institutions. And we do it by organizing EDIR leaders. These are leaders from informal risk-sharing institutions that are well embedded into communities and are, there's evidence that they're highly trusted. And we provide a training directly to the EDIR leaders, and we ask the EDIR leaders to promote for us, if they believe that the insurance is interesting, to their own members, the fact that this insurance exists. So it's not sold by the leaders, but the leaders can inform their members about the existence of the insurance and the potential benefits. And on the other side, we postpone the payment of the insurance premium until after harvest. And the idea behind this is that the liquidity constraint is binding, but it's binding differently throughout different times of the year. And in particular, farmers have sort of this lumpy income that comes mostly after harvest is achieved. So what happens if we postpone the payment of the insurance 6 months later, immediately after harvest, and we sort of cover some sort of fictitious interest rate to cover for the cost of capital? Of course, this introduces a new dimension, which is the dimension that people may agree to buy the insurance and then decide not to pay if the insurance doesn't pay out. In this particular case, we're interested in this. So it's not a design flaw. We actually are interested in this. What do we find? We find that promoting the insurance through the informal risk-sharing institutions increases uptake. It more than doubles uptake. And we do some tests to show that this is not explained by literacy. I will not present the test later, but basically what we do is that we basically test whether the people that were sold the insurance through IDIRS had a better understanding of how the insurance mechanism works. And we also did some placebo tests to control for other things. What we find is that they understand the insurance or they don't understand the insurance equally. So there's something else there happening. And with the delayed premium also increases uptake. Uptake jumps enormously. As I said, it goes up to 43% in one of the treatments that we have. Of course, some of these people that purchased the insurance with delayed premium never intended to pay it back. But even if we look at default adjusted uptake, so excluding the people that decided not to pay the insurance premium, the uptake is actually much higher. And we show that there are ways in which this default has sort of some promising ways in which we can reduce these default rates. In particular, when you combine more stringent contracts and especially selling through IDIRS has sort of, in combination with delayed premium, also has effects on defaults. So this is our contribution to literature. This is the first experiment, I believe, that tests the payment of delayed premium insurance outside the context of contract farming. There's a famous, at least for me, paper of Kasaburi did this in Kenya, but it did it within a framework of contract farming, where farmers were already interlinked with the supplier of the insurance in the sense that they had already agreed to sell their produce to the insurance company. So it's easier, sort of the commitment device is already there. We confirm a study by Stephen Durkin and others that shows that informal risk-sharing institutions have sort of a complementarity effect and have a role in increasing the uptake of index insurance. And we also find evidence that these informal institutions have a potential to reduce strategic defaults. And finally, we set the stage for, as I said, the second and third stage of the experiment, where we play a little bit more with the idea of joint liability, the idea that within these IDIR groups, if one person commits to paying the premium later and then doesn't pay it, the entire group doesn't get access to a little bit along the lines of microcredit, the entire group doesn't get access to this product. So, and this is where we're trying to get to a viable microfinance innovation. So, I think if you're sitting here today, this is going to be very familiar to you, but just to go over the main concepts, weather risks are one of the, or the major source of uncertainty for smallholders, especially in Africa, because most of Africa's agriculture is rain-fed, contrarily to the rest of the world. What do farmers do to respond to this? They diversify activities, they choose safer crops, safer options, which may be less productive, and they underinvest, so they do not replenish the soil from the depleted resources they have taken out, and this sort of leads to a continued poverty trap, individual poverty trap, or this is the assumption, Arun, and it has lasting effects on current but also future income. Now, of course, communities are not, they are by definition, they have a certain degree of resilience to shocks, and they do something about it, typically when people engage in informal risk sharing. We have seen it today. However, typically weather shocks are covariant, so they happen in a very similar fashion in a same community. There is a degree of idiosyncrasy, but in the end, if there's a drought for the entire village. And so these informal risk-sharing institutions cannot cope. They can cope very well with funerals, they can cope very well with malady, but when it comes to more covariant shocks, such as Ebola in Sierra Leone or weather shocks, they fail. And so this is not a sufficient solution, and of course we all know that indemnity-based insurance struggles with issues of asymmetric information, moral hazard, and adverse selection, and especially high transaction costs. We're talking about micro-insurance in this case, and so it's very costly to verify damages. And as I said here in this picture, index insurance comes, it promises to measure index independently and objectively observable outcomes, such as local rainfall, like in the example of this paper, or NDVI, Vegetation Growth Index. It solves in one go the issue of moral hazard and adverse selection, and it has great potential to ensure especially the covariate side of weather shocks. However, as I already mentioned, very few smallholders actually buy it. If you do a review of the literature, I haven't seen a single study so far that has found uptake rates higher than 10% of the target population. So there's only a minority of people that buy this, and if you start looking at who buys this, they're also a very specific kind of people, and they're not necessarily the people that are more exposed to the weather risk that the insurance covers. So what are the reasons found in literature? One is that people do not understand the working, so that's the bottom one. There's a lack of financial understanding of the working of the insurance, and this leads to people sort of shying away from it, and also leads to people having a low trust in the product. So that's the first idea. Trust, of course, also comes with the fact that these formal insurance companies are not embedded in the communities. They're unknown. Typically, these are externally funded projects that arrive to a certain community, and also there's no evidence of a project that has been running for decades. So these are relatively short-term pilots that have been happening. Liquidity, in the absence of complete financial markets, people cannot borrow to pay for the insurance, and this is exacerbated by the fact that insurance, with the way that it normally works, is sold exactly in the time of the year where people are the poorest, what in many countries is called the hunger season. You're starting to plant, you have a bit of reserves, and there's a huge trade-off on whether to invest $5 to buy an insurance or to actually keep those $5 for self-insurance in case things do not go well in the coming planting season until harvest arrives. And of course, there is the issue of basis risk, the mismatch between index insurance and actual damage. We're not going to touch upon basis risk and literacy, although of course they remain very important. We're going to just look at trust and liquidity. So we work together with an Ethiopian insurance company called Oromia Insurance, and it's owned by a farmers' union in one of the regions of Ethiopia. So Oromia, the Oromia region, farmer cooperatives come together, they set up this insurance company, and they have been selling a certain index insurance product already for several years now through their own cooperatives. They have a capacity to target up to 1.5 million farmers, and this is an extended thing. They sell the insurance throughout their cooperatives, and the average uptake at the cooperative level is 7%. So it's a very classic situation of a product that has been going on for several years. It just never took up. What do? We work in 3 districts within the region where they are active, and in these 3 districts we work in several municipalities or kebeles, and we identify every IDIR present. Luckily, there is a registry of IDIRs at the Kebele level, and then we randomly selected, with a block randomization, IDIRs in every Kebele for a total of 144 IDIRs. And then we sort of, for each IDIR, we either provided them with a treatment or a control in this way. So the control is a standard insurance product sold by Oromia Insurance with standard sales through the cooperative. The IDIR promotions, as I said, invites the IDIR leaders to a training, to a full-day training, explaining the workings of the insurance, either the standard insurance model or the insurance model that I will explain later, which we call the IOU, because in a way this is an IOU contract where we postpone the premium payment and we increase it to 106 birr. In a standard IOU treatment, there is only a dynamic incentive. They don't have to sign a contract. They literally just verbally have to agree and sign that they're up for buying this insurance. The only thing they're told is if you buy the insurance and you don't pay at the moment we're going to ask you to pay, you're still eligible for the payout. The only thing that happens is that we exclude you from the next season. So next season you will not be able to take this up. So you can see how this is pointing towards very high, potentially very high levels of moral hazard and very high levels of default rates. In a slightly more stringent case, we actually let them sign a formal, legally recognized contract under the Ethiopian law. So they commit under Ethiopian law to pay back the contract. Now the threat is empty, because we said that we were going to go to court, to bring them to court in case they didn't pay, but of course this would have been much more costly than actually forfeiting the payment, so we had no intention to bring them to court, but at least there is a little bit more credible threat. So this is the way it works. As you can see, the treatment arms are unbalanced, and the reason for this is that we actually were planning from the start already a second and third phase, and we wanted to keep several IDIRs available with a similar treatment in phase 1. The mechanisms, very quickly, we expect IDIR leaders to convey the message in a way that is more trusted to the farmers, increasing uptake. IOU treatment relaxes the liquidity constraint, and when it comes to defaults, we expect the fact that we are selling, that we are marketing the insurance product within the framework of IDIRs to decrease defaults because of increased peer pressure and monitoring, and of course the contract to increase the threat. Very simply, the empirical strategy, we look at the treatment, the IDIR treatment, we look at the IOU treatment, and then we look at the interaction of the two things. So what do we find? If you look at column 2, I'm missing a little bit on the time, we see that both selling through the informal institution and both selling with a delayed premium increase the uptake of the insurance product. Once you introduce interaction terms and you introduce controls, let's look at column 4, we see that actually the coefficient on the IDIR goes down a bit. Another way of looking at this, I think a little bit more clear, is by looking at F-tests. As we can see, there's a significant increase of uptake from the standard to the IOU. However, as soon as you introduce a formal contract, that's column 4, we see that the uptake goes down. So this, we think, is evidence of a clear share of the people in treatment 2 that agreed to buy the insurance but had never had intention to pay back. Yeah? What is interesting to notice is that selling the IOU insurance through the IDIR increases uptake even further, but more importantly, comparing this column to this column, we can see that selling the IOU through an IDIR with a contract does not have this effect of dramatically lowering uptake. So within an IOU, within an IDIR context, the people that were buying the insurance did not necessarily expect to engage in strategic defaulting. So this, we say, holds promise when it comes to looking at default rates. Now, let's have a look at the default rates, also because I think the time is almost up. These are the default rates. We see a very clear downward sloping trend where the lowest default rates are found indeed in the treatment where we sell the IOU contract within the IDIRs with a binding contract. However, none of this is statistically significant, and we'll discuss it later. One reason is, of course, we only have observations for people that did buy the insurance. This lowered the numbers, and there was a very strong, much more than expected covariance in defaults at the IDIR level. So just to summarize the findings, across treatments we find a larger uptake of insurance when we sell through informal institutions. Relaxing the liquidity constraint has an even greater effect on uptake. And of course, as we expected, IOU insurance does invite defaults, but a combination of binding contracts and sales through existing informal networks holds promise. What are the drawbacks of the work we have done so far? Well, first of all, we clearly realized that we had underestimated the IDIR level covariance, especially in the case of defaults, in the sense that there is a sort of a bandwagon effect. If some people default in an IDIR, then everybody feels entitled to default. And this, in our example, basically let our sample size drop down to 90 IDIRs where at least one person bought insurance, and so we had a much lower sample size. And this is a problem per se that we have to study, how to limit this bandwagon effect. Is this a viable innovation? Not yet, even though default rates in the last treatment were around 5%. At current interest rates, this is still not a commercially viable product. And we have, I believe, quite an issue here with determining whether the effect that we observe at the IDIR level is about trust. Yes, we do rule out that this is not that this is a literacy mechanism, but we have no direct measurement of whether people trusted the insurance product more, whether they simply trusted the IDIR leader more, or exactly what is the mechanism at play. And also, we don't know what happens sort of in a dynamic situation where the IDIR members trust the IDIR leader, purchase the product once, then they face a negative basis risk. And what do they do next? Do they lose trust in their own IDIR leader? Does the trust level sort of drop down? So we have to look at this over a multi-year period. A little glimpse, and then I close. On the next steps, we already have a second round where we have introduced this IOU IDIR with the joint liability contract, which is what we think actually is going to hold promise. And we see that uptake rates remain significantly higher than the standard uptake rates. And what we have here is extremely low default rates, about 1%. So we're getting very close to a commercially viable potential microfinance innovation. We still have to, in a third round, what we're carrying out right now, we're looking at willingness to pay. So, of course, we're assuming that uptake rates are not constant with price. So what if we actually take into consideration the risk premium? If we increase the price, what does this do to uptake rates? What is the elasticity? And what we're also trying to do now is to scale up the intervention with only one treatment, where we sell at the individual level through IDIRs this particular product. And orthogonally, or in a factorial design again, we sell what the Durkin paper in itself was arguing for, which is an IDIR level insurance, which then is allowing the IDIR group to allocate according sort of to the idiosyncratic differences. Thank you.
Thank you. Extremely interesting paper. I think so I could summarize my history with the topic of sort of drought insurance in low-income countries as, you know, a lot of optimism back in 2003, and then, you know, these problems that you said at the beginning in terms of, you know, just low demand, low uptake, and then problems with quality and whether these products are actually accurately meeting demands, just sort of, you know, cause challenges for this. And I guess your paper and the paper you cite by Casaburi provide a bit of a ray of light potentially. You know, maybe there is some potential for, you know, something that might be commercially viable. And I recall speaking to the person at the World Bank who leads on insurance regulation, who once described index insurance in Ethiopia as a sustainable market for donor-funded experimentation. So, you know, maybe he can be proven wrong. So I guess in that context, so I just got four comments. So firstly, so one of the points you make, which you sort of have here as well, is in the presentation, so you try to make the payment in period 1 and payment in period 2 sort of intertemporally equivalent, and you do that with an interest rate of 6%, and I think you use the insurer rate of return on investments as that. So
the interbank, actually.
Okay.
Interbank.
Okay. So, but that's so. So when I think of intertemporal equivalent, I would think of either the, you know, time preference of the individual, which obviously you don't know, or the cost of actually supplying a loan to that household. And typically you find, you know, the cost of offering a micro loan to a household is much higher than the interbank rate, because so in here you've got the loan essentially being offered by an insurance company, but insurance companies really shouldn't be providing loans. You know, from a, you know, financial sector perspective, it can lead down the road to ruin for a financial sector. So what you want is banks, you know, that they're set up, or micro lenders. So I wonder whether if you were to use a rate of return which is more consistent with the rates that sustainable MFIs offer in that area in Ethiopia, whether that would change the results. But I think that would be an important sensitivity analysis to do, because your current rate doesn't include any admin costs of this loan, and, you know, making sure that defaults are low, and we know that those, you know, it's quite high serving these clients. Secondly, so on the binding contract, you sort of mentioned that in the paper. I thought it was a little bit, throughout the paper you sort of talk about this being a legally binding contract, and then you sort of say at the end, oh, by the way, it's not really legally binding, it's more like a sort of maybe a social sanction. So you might be a little bit more consistent within the paper about how you talk about that. Is it really, it definitely has some empirical relevance, but it's not necessarily legally binding in the sense that, and, you know, people who, I'd be interested to know if you have any anecdotal evidence for people who defaulted, what actually happened. Were there any sanctions, either from the IDIR or whatever? For your theory, so the theory section, I think you, near the beginning, you tried to, so you're showing two results, and it seemed, so in fact I saw Jan sitting over there, so I'd suggest looking at Jan's paper with Stefan Durkon and Andrew Zeitlin has a nice theory section on trust and index insurance, and
it's already,
okay, perfect, yeah. And then, so it's the final comment, and this is a comment for everybody in the room who's working on, I guess, micro index insurance work. So I think the paper came across as being a bit more optimistic than I'm about the welfare impact of these products. So one thing I would like to see from every single research paper on index insurance product in a low-income country is a scatterplot, please. So what I'd ideally like, given that, you know, data is not perfect, you typically have the weather data for your product because you need that for pricing. So you know historically over the last 20 years which years the product would have paid out for. And what I'd really like to see is, through focus groups, get some recall data for, for the community as a whole, which were the bad years historically, and just show that as a scatter plot. And that will, calm my fears about whether the product is actually providing reliable protection or not. Because my fear in this, there aren't a lot of scatterbots out there, and the only scatterbots that have been published look really, really bad. And that worries me a bit. So nobody seems to have been able to publish a scatterplot that looks good, and I would really like someone to. But if the scatterplots really aren't good, I'd like to start seeing them shown. So I know the paper isn't on the welfare impact, but just from going into these communities with vulnerable households and offering insurance, I think it's important to sort of be able to demonstrate that the product that was being offered was fit for purpose. And I think it's difficult to do that perfectly, but I'd really like to see a scatterplot. Thank you.
Thank you very much. Many interesting points. I will start with the question of the interest rate. Yes, this is literally the lowest you can sort of justify doing an experiment where you postpone payment without being ridiculed that this is simply a matter of time preferences. In the third wave, we have randomized 4 different prices. So this is not 6% per year. This is a 12% per year interest rate in an economy where inflation is about 12%. What we have now is one treatment which has 26%, one has 34%, and one has 42%. And at least for the 42% one, we are fairly confident that this is higher than the, assuming that there is any credit available for these households, is higher than the interest rate they would pay at local microfinance, formal microfinance. When it comes to the binding contract, I think this is something that we are very aware of, and the insurance company, there's no way the insurance company will ever go back to retrieve this. This is extremely costly. So this is an issue which at some point we're hoping to address in a slightly different way. What we're hoping to go at is that this group dynamics, and a little bit like in the case of microfinance, will actually play a significant, microcredit will play a significant role in pushing down default. So we realize that non-enforceable binding contracts are by definition non-binding. So I think we need to be a little bit more clear about that. Now, I did not update the version of the paper. What I've been working on in the last few months is exactly the theoretical section. The model that you have seen does not include anything about trust. Now, of course, there are clear hypotheses stemming out of the model, including sort of the trust effect, or the loss of social capital effect, rather. Welfare aspects, we hope to actually be able to push them all into a second paper, which actually looks more at the welfare aspects. It's very important to look not only at if there's any decision change in terms of what kind of crops people produce, but also looking at whether this indeed has some effects on the variability of income. A scatter plot, to be honest, you asked me this before my presentation, and so I had a little bit of time to think about it. We do have data about the last 5 years and which years people felt were a year of drought and everything, so we could go back using the same algorithm and looking whether there is any correlation there. Hopefully there is. What we can also do, since our insurance product is a rainfall-based insurance product, we can look at whether at all this has any correlation, because we have the GPS locations of every person with the NDVI index. Which is an index of vegetation growth, which could actually also be informative. Thank you very much.
Okay, interesting idea and interesting innovation. So when you motivate your idea, you were saying that your innovation would avoid the trust level, or it would minimize the trust problem or the liquidity constraint problem. But I was expecting to see some information or some evidence showing that, or some level of heterogeneity among individuals with different level of trust or with different level of liquidity constraint in terms of the default or in terms of the uptake. So I think, it might be a good idea to think about or give some evidence whether the instrument is really having some or working through the trust level or the liquidity constraint that you mentioned. Thanks.
Yes, I will respond to this one, and then the microphone can go there. I think this is a very important comment and something that I will take up immediately. When it comes to liquidity, we have some way of proving this because we have some information about the poverty level of households. So what we would probably try to aim at is to see whether the kind of people that buy the insurance under the IOU product are different from the people that buy the insurance under the standard product. When it comes to trust, we actually have our hands tied at the moment. Now, in the next wave of data collection, I do plan to have a much richer data set and a much richer module trying to understand trust. This would be a very, very much exposed kind of data collection, but we hope to sort of cover that hole in our data.
Thank you very much. Very interesting study. There is no consensus about the various reasons why there is no uptake, and it is good that you went through the informal institution in Ethiopia to say something may be improved. I want to throw some comments which might be very useful because we have similar work in Burkina Faso. The first is maybe the uptake is not that high because farmers in Ethiopia don't face only crop failure. Therefore, it may not be a sufficient coverage. The second reason why, even if you go through IRDR, it may not be popular is that historically Ethiopian farmers might feel that they have a better informal scheme, better than the formal product that comes through insurance products that you have there. A third point is in Burkina Faso, for instance, through Planet Guarantee, if you involve the farmers themselves, I think usually uptake improves, but I'm not saying that this is the answer. Finally, it will be nice if you have any information in relation to the amount of contribution relative to the IRDR contribution. For instance, if you go to IRDR, people will be members by contributing some money, even in that insurance scheme. So if they feel that you are adding another contribution that they should be subjected to contribute to, that is a concern. So it is a good idea if you give us maybe a relative ratio of this cost towards.
Yeah, thank you very much. Indeed, so what I think the first question was about perhaps one of the reasons why people don't buy this insurance is it doesn't fit their needs or the actual uncertainties they face. For instance, cropping failure may not be the important one. Indeed, many smallholders in Ethiopia do not only engage in smallholder farming, they typically also have livestock. One thing that sort of assuages a little bit this concern is that this is a weather insurance. So as long as livestock is also affected by droughts, it may cover both. As a matter of fact, a person may buy the insurance policy even if, for some reason, they're not farming. And this also connects to the big fear that what we're observing is actually people buying lottery tickets rather than buying insurance. But it is something that a weather insurance may cover also diverse activities, as long as we assume that these people are affected by extreme weather events. Is it possible that farmers do not buy the insurance because they have better informal schemes? I am very aware that we are not entering a vacuum. So I think that informal schemes do exist. They are functioning. They are historical institution of informal risk sharing. They are imperfect. Sometimes they fail. What is obvious is that, to a large extent, these insurance schemes have to go, at least in countries where these institutions are quasi-formalized, such as it is in Ethiopia, in a direction where basically you are empowering these institutions to function in cases where they actually end up failing. So in that sense, in our third wave, what we're hoping to do is to have this insurance. This is something that other people are very likely doing already at the same time as we are, giving group-level insurance, which then they are able to, it actually empowers them to do informal risk sharing. Planet Guarantee going directly to the farmers. I'm aware of the existence of Planet Guarantee. I'm not aware of how they differ in the way they do the things compared to Oromia insurance. In Ethiopia, Oromia insurance is one of the most direct farmer-led approaches because we all know that Ethiopian cooperatives are not exactly bottom-up institutions. but there is an idea there that farmers, it's farmers, and it's actually a person at the cooperative level that sells, that is present from the agency selling to the farmer. So it's a very much direct approach, and yet we don't see this. But maybe you meant something different. Maybe you can expand. What was your last point?
No. I think it is a ratio of the contribution to insurance relative to the contribution to
that. Thank you very much. I will look into that. Very important.
A question on trust. You have observed those farmers over a few seasons, so you could also look into if they did receive a payout, if they are also raising the trust, just as you mentioned about having the basis risk, which can reduce trust. I don't know if you have looked into that already, or you plan.
We plan to look into that. One problem that we will have is because these are actually 3 different seasons, what we will have is people that received payout in year 1 and people that didn't. People that didn't receive it but had a case where they actually did face a drought, and the ones that didn't. And this applies also to year 2 and year 3. So it's going to be quite difficult for us to look at trust effects under different scenarios, but we hope to look into it. We don't have the data yet, so. So your question is there some substitution effect between buying the insurance and actually buying credit? It's a very good point. I think we also will have to look at informal credit, but also to the extent that credit is used as a form of self-insurance, I would expect a degree of substitution. So thank you very much. Okay, a wonderful set of questions. Thank you very much. I think it was a great session. Thank you for your comments. And see you all next year at the CSAE conference.